Hey guys, I'm going to walk you through credit spreads, assignment risk, what it looks like. I'm going to give you an example, and I'm also going to show you how you can manage that assignment risk to protect yourself and end up with less of a loss, or maybe not even a loss at all. I'm also going to walk you through how you know when to chill and when you should worry, and the steps you should do when those comes up. So let's walk through this video. It's going to be super helpful. Smash the subscribe button. Let's get started. Alright guys, this video was inspired by a recent coaching call I did when someone asked this question, so I wanted to lay this out for you since you may be having the same question. What is assignment risk? What does it look like? And how do I manage it? So if we're looking at this, essentially what assignment risk is the person that you sold an option to wants you to pay out for it. And so again, this can happen whether it's on expiration day or anywhere before that. However, it is only profitable for the person who you sold the option to execute that option if it's in the money. Why? Well, when we structure a credit spread, we have an option contract that we sold. So let's say we sold one put contract here, and then we bought another. So we have one put that we sold and another put that we bought. This is how we structure a spread. And so with that, the one that you sold is at risk of assignment when this spread is in the money. Now again, the further you are in the money, the more profitable it is for the person you sold this option to. If it's just barely in the money, then it's not really it's not profitable for that person to execute that contract. Why? Because they make the difference, or they're saving the difference of where the stock is and the strike price that you picked. So the further of a distance between the stock and the strike price when it's in the money is the amount of money they will save, and more advantageous for them to put on that trade or make, depending on if it's a put or call credit spread. So that's why the further you are in the money, the higher of assignment risk you have. So first and foremost, if you are really far in the money, you should start to worry. You're at a high risk of assignment. If you're just barely in the money, your assignment risk is very, very low. And so that's not something you really have to worry about. So what is an example of assignment risk for someone who has never gone through it? All right, well, let's take a rough example. Let's say that the stock that we're looking at is the S&P 500, and it's currently trading at $440. Let's say that we have a put credit spread on this, meaning we want the stock to stay above the 435 level. Oops, why am I doing 3 first? 435. So that means that this 435 is a strike I'm selling, and 434 is the one that I'm buying. Well, I do one good 3, one bad 3. Anyways, so that means that we're going to sell an option at 435, and we're going to buy an option here. Okay, we're currently at 440, so that means that the stock is trading above our strike price. We have nothing to worry about. But what happens if the stock goes down? What happens, let's say the stock is now trading at 430. So if the stock is now trading at 430, I'm in the money because this stock is under all my levels that I want to stay above. So what does this look like? So let's say that the person sees the $5 difference between the 430 stock price that it's currently at and the 435, and they want to get rid of their shares at 435 instead, so they have a $5 profit or less of a loss. So what is going to happen here is they're going to call their broker. They'll be like, yo, broker, I want to execute this option that I have. And the broker will be like, okay, let me see who owns that, and I will get the shares from them. So they're going to execute this. So in your account, you're going to get 100 shares. This is a put credit spread, so that's the ability for them to sell their shares at this price. So now they sold their shares, so that means that because they sold their shares, you took on those shares at that level. So now you have plus 100 shares for this put credit spread at a price of 435. So when you're in the money and you get executed, your option that you sold for a put credit spread gives you 100 shares at the strike price. Now remember, it's currently trading at 430 and you got it at 435, which means you now have a $5 loss per spread. Or again, there's 100. Each spread represents 100 shares, so you're at a $500 loss approximately. All right, What happens to the plus one? Nothing. You can't get assigned on a contract that you own, one that you bought. You cannot be assigned. But what you can do, this is the first option for getting out of assignment risk, is to simply do what that person did to you on your contract. Be like, yo, broker, I got this option. I got these shares. Can I execute my option so that I can get rid of these shares? That's what this protective put here is for. And they go, yes, let me see who owns this. So they're going to execute this option and sell you out of your 100 shares at $4.34. So now instead of the $5 difference between where you have the stocks and where it's trading, you're now only going to have a $1 loss, because that's the difference between your $4.35 and $4.34 strike price. Because this will execute, which means minus 100 shares at $4.34, and so now you'll experience the max loss that you saw on your broker when you initially placed the trade. That is option number one. Option number two, so let's put number one. Option number two is quite simply this. Take these shares and get rid of them. Just sell them and then use the put option that you have and allow it to run and make money if you expect the stock to go down lower, right? So we're going to get rid of these shares because this is a bullish position and obviously a bearish market. It's a put credit spread, which means the stock is going down. So what happens here is we want to get rid of the bullish part of this position. We want to hold on to the bearish part, the put contract that's going to go up in value as the stock drops. And what does this mean? It means that I take a small loss here, but on this is going to recoup a lot of my losses. So I allow this to go up in price, and this is going to offset a lot of my losses. So that's option number two. Again, this is for if you expect the stock to continue to go down. If you expect the stock to go up, if you see it's at support and you think it's going to bounce, what's going to happen? Well, quite simply, all you do is you do the inverse. You get rid of your short position, which means you get rid of the put credit spread you have, because that's going to lose money as the market goes up. Then you're going to keep this position because it's bullish, and so as the market goes up, you won't have your bearish put, you won't have this put contract. Instead, you'll have this, so this will go up in value, and then you can close it and offset any losses. So the reverse is going to be potential number three. Now, by default, one of the easiest ways to manage risk if you've been assigned is number four. Just close out everything. Simply take the shares, sell them, take the put contract, sell them. Your loss is going to be really equivalent to your max loss, which is what you knew when you originally entered the position. So that's what can happen. That's what it looks like. That is assignment risk. So when do you worry? The further you are in the money, the more you should worry. If you are just barely in the money, there's no worrying at all. But I do want to mention a small caveat is with calls. Call credit spread. Just because you're barely in the money, you can still be at a super high risk of being assigned in a certain situation. It is called ex-dividend date. And I don't know if you are aware of ex-dividend date, but this is the date where, let's say if you're trading a stock or ETF that offers a dividend, then the ex-dividend date is, hey, by this date you have to own shares in order to get the dividend. So what people will do is they'll have a call option that they bought from you, or the one that you sold, and if it's close to in the money, they'll execute that trade, or they'll assign that risk so that they now own shares, and when they own shares, now they're eligible for the dividend. So 1 to 2 days before or on the before the ex-dividend date, if you're trading a call credit spread and you are close to in the money, you are at risk. That is something you need to worry about. So if you're trading call credit spreads, you also have to watch, outside of in the money, the ex-dividend date, because that will play a big factor. Anyways, that is assignment risk. Those are 4 ways to manage it. And then another tip, I hope you enjoyed it. Smash the subscribe button down below, because I come out with videos just like this. If you want to learn more about credit spread trading and the exact strategy I use to have an 85% win rate, risk $3 to make one, then click the free link down below, which is my free credit spread trading course. Literally over, I think it's like 5 hours of in-depth training to help you become a better credit spread trader for free. Anyways, guys, I will see you in the next video.